Section 1. A simple guide to building wealth minus the confusion. This is a beginner-friendly guide to ETFs to build long-term wealth. If investing feels confusing, complicated, or like it's designed to keep you out, this is for you. My goal is to remove that confusion and give a clear, simple strategy. You do not need a finance degree. You do not need to watch the market every day. You just need a simple plan and the discipline to stick with it. This is not about complex charts or Wall Street jargon. It's about taking control of your financial future the easiest way possible. We're going to break down exactly what an ETF is, why it's the perfect tool for a new investor, and how you can get started with as little as $50. The financial industry often makes things seem harder because complexity is profitable for them. Simplicity, on the other hand, is profitable for you. Section 2. What exactly is an ETF? A simple grocery bag metaphor. So, what is an ETF? The name, Exchange Traded Fund, sounds technical and intimidating, but the concept is incredibly simple. Forget the fancy name for a moment. Think of an ETF like a grocery bag. When you go to the store, you could buy one apple, or you could buy a pre-packaged bag with many fruits. Apples, oranges, bananas, grapes. An ETF is like that pre-packaged bag. Instead of buying one single stock, one apple, you buy the ETF. A single item that holds many different stocks. You buy one thing, but get a piece of everything in the bag. The bag is traded on a stock exchange. Its price moves throughout the day as people buy and sell. For anyone new to investing, the sheer number of choices can feel overwhelming. This is where ETFs shine as the easiest and safest entry point. Their simplicity is their biggest advantage. Instead of becoming an expert on hundreds of companies, you make one decision: which broad market ETF to buy. This single transaction puts your money to work across the entire economy. It removes paralysis and lets you get started immediately. You can buy them through any standard brokerage account or modern investing app. Many brokerages offer fractional shares. If a share costs $400, you can invest $50 and own an eighth of a share. The safety of ETFs comes from built-in diversification. Spreading across many companies lowers your risk. Fees are famously low, often just a few hundredths of a percent. Choosing low-cost ETFs keeps more of your money invested and compounding over time. Comparing ETFs to individual stocks is like the tortoise and the hare. Picking individual stocks is the hare's game. It's exciting, fast-paced, and promises a big, quick win. You might hear stories of the next big tech winner. However, this approach carries immense risk. Most get it wrong. It takes time, research, and expertise. Even pros miss often. An ETF, specifically a broad market index ETF, is the tortoise. Slow, steady, a bit boring. You buy a piece of the entire market. Growth comes because economies tend to grow over time. There will be bumps, recessions, and crashes, yet innovation drives an upward trend. Stick with the tortoise, and you win the race to financial independence. You will not get rich overnight, but you will build wealth surely and steadily. When you start looking at ETFs, you'll find thousands to choose from, each tracking a different part of the market: technology, healthcare. Others focus on themes like clean energy or artificial intelligence. For a beginner, the best and simplest choice is a broad market ETF. Don't hunt needles. Buy the whole haystack. A broad market ETF mirrors a major index like the S&P 500. It's 500 of the largest U.S. companies across industries. Buy an ETF tracking it, and you're a part owner of all 500. Examples include VOO and SPY. Total market funds like VTI hold thousands, large, medium, small. Winners offset losers. For most investors, a low-cost broad market ETF is an effective way to build long-term wealth. The single most important concept for any new investor to understand is diversification. Simply, don't put all your eggs in one basket. A single stock can fail and wipe you out. Chasing hot tips is a painful beginner mistake. ETFs solve this instantly. With one click you own many companies. It's diversification in a box. It smooths the ups and downs. Volatility. One company's bad news barely moves a broad ETF. You're tying success to the whole economy, building on stone, not sand. This safety net helps you invest with confidence and sleep well. One big anxiety is trying to find the perfect time to buy. That fear often leads to inaction and missed growth. The solution is dollar-cost averaging. Invest a fixed amount on a regular schedule, no matter what markets do. Say you invest $100 every month. At $50, you buy 2 shares. At $25, you buy 4 shares. At $100, you buy 1 share. Total $300 for 7 shares. Average cost about $42.85. You automatically buy more when it's cheap, less when it's pricey. Automate it, remove emotion and guesswork, and turn volatility into an advantage. You do not need thousands to start. Modern brokerages and fractional shares let you begin with $50 or $100. You can buy a small piece of 1 share. If VOO trades over 400, 50 still buys a fraction. You're officially an investor. First, open a brokerage that offers fractional shares. Second, link your bank and transfer your starting amount. Third, choose a broad market ETF, VOO or VTI as examples. Place an order for your dollar amount. Set up recurring investments. Even $50 a month can compound. The journey begins with a single step. In investing, it can be as small as 50. You buy ETFs through a brokerage account. A brokerage is licensed to buy and sell investments. Think of it as a store for financial products. Opening an account is simple and online. Large established firms offer long history, service, and low-cost options. Newer apps provide sleek interfaces, commission-free trades, and fractional shares. Fund your account, search the ETF ticker, VOO, VTI, and place a buy for your amount. The platform executes the trade. Now you own your ETF. Finally, set automatic, recurring investments to keep it effortless. There are common traps that cause new investors to stumble. First, trying to time the market. No one can do it consistently. By the time it's in headlines, gains often passed. Stick to your broad market ETF. Panic selling locks in losses and misses recoveries. Declines are temporary. The long-term trend is upward. Avoid overchecking your portfolio. Set up automatic investments. Trust your simple plan. Get on with your life. Your wealth grows best when it works quietly in the background. Invest consistently in a low-cost, broad market ETF and hold long-term. It harnesses the engine of capitalism. You own collective innovation, productivity, and growth. As companies create value and profits, your shares grow. You're betting on human progress. Compounding makes returns generate their own returns. Time and low costs are key. It's simple and easy to stick with. Automation removes tinkering, timing, and panic selling. You take your slice of the economic pie and let it grow over time. We have covered a lot of ground, but the core message is simple. You can build wealth. An ETF-based strategy is the easiest way to start. Open a brokerage account, set up a recurring monthly investment into a low-cost, broad market ETF. Have the patience to let it grow for years and decades. Your success is decided by your discipline during the bad times. Commit $50 or $100 a month. Open that account. Set up that first transfer. Make your first investment. The sooner you start, the stronger compounding works for you. Be patient. Be disciplined. Stay the course. You can do this. The information provided here is for educational purposes only and is not financial advice. All investing involves risk. Consult a licensed financial professional for guidance tailored to your situation.